have a few announcements regarding some events that we're going to be putting on via LinkedIn and other platforms, some very important headlines this week related to tax enforcement and some emerging tax issues in the digital asset space, and then some case studies and some other important information that I want to deliver to you guys from some of our blogs and from just some of my experiences serving clients at Camuso CPA. So there's a lot I want to cover today, and I'm looking forward to getting into it here. Let me share my screen, and we'll get right into it. All right. So first, I want to go over just real briefly on March 7th. I invite everyone to a Crypto CPA AMA. This is going to be where you can come and ask me questions that are top of mind related to taxes, accounting, any regulatory topics. You can go to LinkedIn and sign up for this. This will be at March 7th at 10 a.m. So I encourage you to check that out. Additionally, we will be having Joe Chickolo from BitAML onto the Financial Frontier as our second podcast guest. This will be on February 26th at 10 a.m. So I encourage you to go ahead and sign up for this as well. You can go and sign up for the event on LinkedIn so you get notifications when we go live for this event. We're going to cover a lot of great information on this episode with Joe. I've known Joe for years, and he has a ton of experience within this industry helping a wide variety of clients. So there's going to be a lot of information in this. So I'm really looking forward to this. This is February 26, 2024. So definitely be sure to check that out. Okay, so now it's time to get into some of the headlines here. And I was pretty surprised when saw this headline because we haven't seen many headlines like this to date, but I believe, what I've been saying is this is going to be the year where we really do start to see a lot of this and start to see this ramp up. And that is tax enforcement for falsely filing cryptocurrency on tax returns. So this headline is from the Department of Justice's website. And it says, Texas man charged with filing tax returns that falsely report his cryptocurrency gains. So again, we're going to be seeing a lot of this because obviously, tax enforcement is going to be one of the big themes here in 2024. So defendant purchased $3.7 million home in Bitcoin. So a federal grand jury indicted a Texas man for filing false tax returns and structuring his cash deposits to avoid currency transaction requirements. So this indictment is alleging that between 2017 and 2019, that this defendant, who's in Texas, filed false tax returns that underreported or just simply did not report the sale of almost $4 million worth of Bitcoin, which they claim he had substantial gains in. In 2017, apparently, they're saying he used these proceeds of the $3.7 million to purchase a home. And in 2017, he filed a false tax return that inflated what he paid for the Bitcoin. So it seems like maybe he filed the fact that he sold the Bitcoin, but he inflated his cost basis. So his net proceeds that he would get taxed on, or his net capital gain that he would get taxed on, would be smaller. So he inflated his cost basis there by underreporting his capital gains. And in 2018 and 2019, he sold more than 650K and they're saying allegedly failed to report these sales of Bitcoin in 2018 and 2019. So he's just underreporting his gains. And, the IRS is, like I said, only says there's a 25% compliance rate, 75% non-compliance rate. So this is one of the early examples of them actually prosecuting somebody for this. So then they also say that after he sold the Bitcoin, that he made a series of bank deposits in cash for less than 10K each to avoid currency transaction reporting requirements, which is, I think, interesting considering, he was filing this, he was just filing them wrong. And then he tried to structure these deposits, which I think it's a little odd on why he would structure them. But, that's going to be another charge that he's going to have to deal with. So he faces a maximum penalty of 5 years in prison for each structuring count, and 3 years in prison for each false return count. So they're saying he had false tax returns in 17, 18, and 19, and he can get 3 years on each of those. So just on those three tax returns, he could be looking at 9 years in prison. And then you also have this structuring charge. I don't know how many deposits of under 10K he made. If he's they're saying he sold close to 4 million, 3.7 million, and he was making deposits at 10K or under. So I'm sure he's got quite a few structuring charges to deal with as well here. A federal court judge will determine any sentence after considering the sentencing guidelines and other statutory factors. Man, so this is just going to be a mess for this guy, and this is why people like me have been preaching for years and years and years to file your taxes accurately, because it does take time for things like this to come to a head, but ultimately they do, and then you can be faced with serious consequences. So I expect to be seeing a lot more of this, and this should sort of serve as a warning to the industry as a whole, to the 75% that the IRS says is out there that's not accurately reporting or not reporting at all. It's time to get into compliance. The sooner the better. If you have inaccurate tax returns, amend them to be filed accurately. If you haven't filed your tax returns, start working on getting your accounting updated and getting these filed accurately, so you don't end up in one of these headlines or with a really severe tax notice that's going to impact your bottom line. So the next headline I want to discuss is, again, on the tax enforcement front, but this time with an international focus. My firm mainly focuses on working with clients in the United States, but we can look at what tax agencies are doing across the world related to crypto, because a lot of times seeing what smaller countries are doing can inform us on sort of what the future looks like in terms of some of the positions we may see other tax authorities take here in the States. And some of our clients do end up getting international exposure, but mostly US. So this headline is Spanish Treasury to seize crypto to pay tax debts. So Spain's Ministry of Finance has announced tax reforms that will give financial organizations the power to collect taxes on behalf of governments. So basically, the Ministry of Finance in Spain, they're looking to expand their control to monitor cryptocurrencies and take enforcement action. So this bill would allow them to seize digital assets to settle tax debts. So, in the event that someone there is not reporting their taxes accurately and they're found guilty of that, they want to be able to come and take their Bitcoin. This is actually something we've seen the US seize Bitcoin, not specifically on tax related cases, but on other types of fraud related cases. We have seen that. So as it goes on here, it says, the Spain Treasury is also planning to fight tax evasion more aggressively, and it's looking to force banks and electronic money institutions to report on all card transactions. So they're in Spain right now making a pretty big compliance push, or at least positioning themselves to do so. So, we'll continue to watch this, but this really just looks like Spain is gearing up for some more tax enforcement in terms of positioning themselves to be able to seize crypto. They're looking to make banks and other money institutions give them more informational reporting, and then they're also giving their citizens deadlines on when they should actually, be reporting this information. So Spanish residents holding any crypto assets on non-Spanish platforms have until the end of next month to declare them to tax authorities. So they're going to have to, again, like I'm assuming in Spain, people are, have a high level of non-compliance, just like in the US. That's why you're seeing these enforcement measures in terms of data collection and positioning for future enforcement. So it'll be interesting to see what happens here. So Spain will be under the Markets and Crypto Assets regulation, also referred to as MICA. They will be involved with that, and that will take place December 2025. So it's going to be 6 months before this deadline that they're giving here. So this is interesting. We'll see what comes to this, and what sort of the next shoe to drop here is going to be in Spain in terms of tax enforcement. So this is another big emerging issue that you may have heard me sounding the alarm on now for over a year or so, and that is sales tax on NFTs. Now, this is an article out of Thomson Reuters. Sales tax on NFTs poised to heat up in 2024. And again, this is something that I've been highlighting, and I've been, warning clients about at Camuso CPA, and just warning everybody about through the information that I put out. Via my blog at Camuso CPA, we actually made another website called Digital Impost, where a lot of the information related to sales taxes is posted. And I even wrote a book on this topic where I compare the emerging sales tax issue related to NFTs as a Wayfair 2.0, where Wayfair 1.0 was related to interstate commerce that was really brought about by the big e-commerce and internet boom that we've seen over the past decade. Now we're moving into this Web3 era where everyone is going to be transacting on chain through various digital assets and real world assets. And this is going to create a whole new host of sales tax issues that are going to have to be clearly defined, and with some clear guidance at the state level. And we have seen some of that this article will cover, where we've seen Washington, we've seen Pennsylvania, Minnesota, we've seen other states give preliminary guidance on specifically NFTs, and those states are taxing NFTs based off of certain criteria related to the overall nature of that NFT. But that's what this article is highlighting here, is that there's a handful of states that have provided guidance for NFT, or sales taxes on NFTs. Guidance from these states include Washington, Pennsylvania, Wisconsin, and they go on here to say that this is going to be, they talk about the state look-through approach, which is the approach that we see most states taking, such as Washington, where there's going to be some look-through approach where you're going to look at the underlying nature of whatever this NFT is supposed to represent. This NFT can represent some type of good, like a shoe or a ticket or something, something physical like that. It also could even represent a service. If I was to say sell a NFT as a connection to being able to get a certain level of service at my firm. So they go on here to highlight each state's approach. I have really covered this ad nauseum for each one of these states. If you go onto my YouTube channel just by typing in Patrick Camuso, you will see in-depth state-by-state videos on these sales tax topics. And again, you can check out our blog, and we have state-by-state guides on blogs. And there are some unique issues that I've also dedicated full videos and full information to that I'd like to see if they cover here. Some of the things they didn't actually. So some of the other issues that I cover and that I would encourage you to check out if you're drilling down on this issue is retroactive tax applicability. States like Washington, the way that they're taxing NFTs is including them in their definition of digital products and goods. Therefore, they can apply retroactive taxes to taxpayers who have done past sales who haven't, reported these sales appropriately. And the overall challenge with this at an industry level is going to be the level of information that has to get collected on non-custodial wallets. So in order to get an accurate sales tax rate, you want to use rooftop accurate rates, which basically means that in order to calculate this, due to the way that tax regions are versus the postal mailing code system, you need their full address. You need the full street address, county, and zip code. That's what is going to get us an accurate rate across all states. So in order to get that, you're going to have to be collecting this from your customer at the point of sale or at the point of mint. So it's going to be additional information that states are going to require NFT sellers to start collecting. And I foresee, just like what some of the things that we've seen at the federal level with the proposed broker regulations, Form 8300, people desire pseudonymity with their non-custodial wallets, but all of these regulatory pushes are basically to eliminate that or remove a large portion of it. So there's going to be some friction there, but at the end of the day, what we've seen states like Washington do is place this burden on the seller ultimately, because there's a sourcing hierarchy that Washington has outlined, where if you don't collect this information from your buyers, if you're not going to collect their address information and you're not going to accurately calculate rates, then basically the assumption based off the sourcing hierarchy ultimately, because it's a 5 or 6 part hierarchy, but ultimately, it goes back to the seller's location if there's no other available information. So if someone in Washington wasn't collecting the appropriate information, all those taxes are going to fall on them based off of their address. And if you're a company out there that's selling NFTs, you should be charging this sales tax to your customer and then remitting it to the state. And if you get put in a position to where you don't collect this from the customer and the state still comes looking for the remittance, you're going to have a tax liability on your hands that's going to impact your bottom line. So again, this can all be applied retroactively. So I view this overall as a huge risk for any Web3 company or NFT artist that is selling NFTs. And this is going to be something that I track very closely and that we're assisting clients with. So I will keep you updated on this, and I will continue to watch this closer. So they did talk about some of the sourcing issues at the bottom here. So yeah, I encourage you guys to check out this article out of Thomson Reuters. It's good, but also visit our website at camusocpa.com, visit our other website at digitalimpos.com. Check out my book, which is available on Amazon, Wayfair 2.0 for Web 3.0. And I have put out a ton of in-depth information on this topic, and will continue to do so as things develop in this space over this year and the years to come. So now I wanted to get into another client case study. Now I have this client case study posted on LinkedIn. We've actually been posting these case studies in a blog format more recently to our website at camusocpa.com. So I encourage you to check that out as well. But basically, this case study is, I'm not going to go over it word for word, but basically this was a summary of a client that we worked with, still do work with, who does nodes as a service. And basically, before us, they went to another CPA firm and were advised to, treat these nodes as a service as an active business. And then they went and they made, they built entity structures based off of these tax assumptions. They created an S corporation. And then, we started working with them and realized that the level of activity that they're investing into this, these passive nodes as a service doesn't rise to the level of a trader of business for this particular client. and basically had to work with them to unwind all of these issues that were created by them applying the wrong tax treatment and the wrong entity structures to something that just should have really been a passive individual activity. So that creates a tax mess. And I see a lot of people trying to create companies for passive investment activities because they perceive that there's going to be some tax benefit associated with it. Really, all this is going to do is create tax nightmares and accounting nightmares for you. So you want to be very careful when you're doing this. And if you're going to create a company for your digital asset activity, you need to have an active business that rises to the level of a trade or a business. If you're just parking some money in a note as a service, as a passive investment, chances are this doesn't rise to the level of a trade or business. Now, this is a facts and circumstances based test. It needs to be looked at on a case by case basis. But generally speaking, my expectation would not be that this would rise to the level of a trade or a business for the average taxpayer. Then another huge issue that we had with this client, which is basically, a consistent theme at this point, is that there was lack of due diligence on their portfolio calculations. Specifically, when if a client comes to me and they're looking, maybe they've had 4 years of accounting done, they want us to do 2023 for them. Our starting point is to look at your detailed ending cost basis at the tax lot level for 2022. These need to be accurate. The second we got into this with this client, and this again is common, we quickly realized it was inaccurate. It was riddled with inaccuracies. Simple things where there's assets that should have a cost associated with it. We're staring at a zero cost for assets that definitely have a cost associated with it. When reviewing it with the client, we point out specific assets to them to confirm the ending balances. They're either, significantly overstated or understated. There's just discrepancies, and it's clear that there was never due diligence done. When I asked this client, did you go over with your CPA your actual holdings compared to these calculated holdings? The answer is no. So basically all of their accounting was worthless because it was all inaccurate. There was no due diligence done on it. There was several assets materially inaccurate, either overstated or understated depending on the scenario. So that creates many issues because now we have inaccuracies in the prior tax years, but also because this hits your ending cost basis, this is a cumulative issue that carries into the next year as well. So these types of accounting errors can haunt you for years and years. So you want to get things accurate, and you want to drill down on that ending cost basis report and make sure that everything is accurate in there. So in this one, the firm conveniently shifts blame, attributing all the shortcomings to softwares and things like that. I mean, at the end of the day, you need to be doing your own due diligence. You need to be verifying the accuracy of this. Anyone with any level of experience knows that none of these software solutions, as much as they're needed, are going to be perfectly accurate. They're all going to require manual updates, diligent reconciliations, and just overall due diligence and verification of for overall accuracy. So basically we had to go back for this client and work to clean up this whole entire mess, starting with cleaning up all of the accounting, then cleaning up all of the tax issues, amending all of the tax returns, and finally getting them to a point where they are in tax compliance and they have accurate accounting records, including at their cost basis level. So when they go into next year, it should be smooth sailing. So that's what we did with this client here. So then lastly, we do have a new blog post this week that I would encourage everyone to check out: Web3 tax planning for play to earn games. So here in this article, over the overall tax landscape for play to earn games for both, companies participating in this space as individuals, and then some of the tax implications And the transactions within these gaming ecosystems can take many forms. You may be exposed to capital gains, income taxes, sales and use taxes, among others. So we cover all of that in this article, and go over some of the important accounting considerations, due diligence considerations, steps to documenting. So I encourage you guys to check this out. I think it's a valuable article. There's a ton of information at camusocpa.com if you're looking to learn more about play to earn taxes, or really any tax subject related to Web3 and digital assets. So, those were most of the items that I wanted to go over here today. As you can see, one of the big themes of this talk we had today are tax controversy really taking the center stage for 2024, with new tax issues like sales taxes emerge as we continue to see the industry expand and regulators start to gain a deeper understanding of the space, but also just seeing the growth in the space, understanding that this is going to be something that they want to address. So it does take time, I think, for regulators to position themselves for a lot of these enforcement actions. But again, I think this is going to be a year where we see a lot of this, and we're starting to see some of the beginning headlines of this now. So we will continue to watch this closely. I hope you got value out of today's episode, and you got some information that you'll be able to use for your company, for your portfolio, or for your practice. And I appreciate you taking the time to watch. Until next time, I'm Patrick Camuso, signing off.